Clearly there's a lot of uncertainty around Greece and the implications for markets, in particular European equity markets at present. Just looking at the level of deposits, as we can see here, the level of corporate and household deposits in Greece have tailed off quite sharply over the past 5 months. This is based at 100 in the beginning of 2010, but you can see the decline more recently has been very sharp. Something like 30 to 35 billion was withdrawn in the first 4 to 5 months of the year, and no doubt that has accelerated in June up until the last couple of days. So when we look at the referendum, this is clearly going to be a key for markets coming up on the weekend. A no vote, which could potentially end up then with the ECB withdrawing its emergency liquidity assistance. That would increase the probability of Greece actually exiting the euro. One of the major concerns for markets at the moment is that the events going on in Greece at the moment could actually increase the focus on other parts of Europe where the anti-austerity parties have grown in popularity, and this would further add to uncertainty going forward. A yes vote would also carry with it problems, but would likely entail a change in government and potentially an agreement to a new deal. So in this video I want to have a look a little bit more closely at the equity markets in Europe and make some observations on valuations. At the height of the European crisis, or sovereign debt crisis in 2011, really the September quarter or early December quarter 2011, as we can see here marked by that dot on the valuation chart for European equities ex-UK, you can see the PE got down to under 9. What's interesting now is that the PE recently rose above 16, although it's since pared back to closer to 15. So on this basis, the forward PE ratio for Europe ex-UK would appear to show that that market is actually expensive. What else was going on at the time of the previous debt crisis? As we sort of scroll through some of the other indicators, the Italian 10-year bond yield, which had been pushing up from 4 up through 5, eventually reaching 7. In Spain, where we had bond yields once again pushing up through 5 on their way to 7%, and of course Greece, where they were pushing up through 16, got as high as 28. We saw the rally back down, and then more recently we've seen the yield on the 10-year bond move up above 14%. Now, if we look at some other measures over this period, we can see European IP. This is 12-month change in European industrial production at the time of the European debt crisis. In fact, coming off a peak, as the world recovered coming out of the GFC, we saw quite strong levels of activity across the globe, and Europe was no exception. So the European debt crisis occurred just as the economy was coming off a surge in growth, and that also shows out in measures such as the IFO Business Climate Index, once again coming off very high levels. So it occurred at quite a bad time where activity was already in the process of slowing down. Now, I already mentioned what was happening to the forward PE. If we look at in terms of earnings, this is trailing earnings, and once again, similar to the economic indicators, that crisis occurred at a time where earnings were at relatively high levels and subsequently fell away quite sharply. What's interesting is this chart is that earnings have continued to decline until more recently. So European markets would appear to be expensive based on history, as we just mentioned, with the PE up around about 15 times. And when we look at them compared to global equity markets, you can see the PE rel is around about 6%, probably a 6 to 7% discount to global markets. Last time in the depths of the European crisis in 2011, that got to about a 15% discount. So on these two grounds, you might consider European equity markets to be somewhat vulnerable, particularly if Greece votes no on the weekend. Just want to point out, however, that that valuation is based on quite weak earnings numbers. As we showed a little bit earlier on, earnings have been coming off for some time, and if we look at the long-term trend in earnings, and we'll just have a look at this, the purple line shows European trailing earnings per share. The gold lines are the trend lines going back to the sort of mid to late 1980s. So you can see here they're below trend. So if as seems likely based on some of the economic indicators that we're seeing a bit of a trough in earnings going forward, and if we see some sort of return to trend, then arguably the market is not as nearly as expensive as it might appear, and perhaps not quite as vulnerable. Now, one way of looking at that is to do the Schiller PE for European equities. So here we're just looking at the PE relative to the 10-year moving average of real earnings, and we only have a short history in this particular chart, but you can see here that that PE, or a CAPE PE for Europe, is around about 14 times. It did get up to about 15 recently, so at about 14 times, and that compares to the level achieved in the European debt crisis of around about 12. Actually subsequently fell a little bit lower. So perhaps the market is not as expensive as it seems, only however if you believe that earnings are in the process of troughing and have at least a reasonable prospect of moving back closer to trend over the period of time. The risk, of course, at the moment is that the uncertainty that's emanating from Greece would undermine confidence and lead to some sort of downturn in a lot of these economic indicators, and therefore either postpone or either delay, or even worse, postpone any or totally abort any improvement in earnings going forward. What is a concern, I suppose, more recently is that the indicators such as IFO business expectations out of Germany, which had been improving a little bit in the last, say, 3 to 4 months, just turned down slightly in June, and that was prior to these latest events. And the business climate index also just coming off very slightly. So we'll be watching very closely these measures over the coming months for signs that the uncertainty in Greece is flowing through to the rest of Europe and undermining confidence and undermining the expectations of an uptick in the earnings cycle and a potential return back to something like trend earnings, which, if that doesn't occur, then would mean that the European markets are very vulnerable to further downside. Outside of that, the longer-term risks really for us remain the political risks and the rise of in the popularity of the anti-austerity parties.